Now you're thinking about investing, all right? What are the three areas that you want to consider having your assets in? And we consider it three buckets: one guaranteed, one variable, and one emergency. The guaranteed is your Social Security, your pension. It's going to be a set income stream coming out to you to meet your expenses. Variable bucket's going to be at the ebb and flow of the market. It's going to have volatility and risk to keep up with inflation. And then you're going to have your E bucket. That's your emergency money that you can absolutely take no risk with. It's going to be the money that you need to get your hands on immediately to meet whatever need that you need to meet.
So now we've gone over your buckets: your guaranteed bucket, your variable bucket, and your emergency bucket. Now we need to think about what we're going to put into those buckets. What are those investments, and what do they look like? And what risk return do those investments have? So we might want to think about like CDs, certificates of deposit, savings accounts, stocks, bonds, mutual funds, ETFs. So let's look at a graph where we're going to illustrate return and risk. And let's see where these different investments fall within this graph. So if we start out with like CDs or savings accounts, some things that are really low returning, maybe low risk. Then let's look at where would bonds play a role? Maybe a little more return, a little more risk. And then stocks. Where are we going to get that real growth over time that's going to grow these assets, possibly generate that income that we need? Certainly going to have potentially more risk and more return. So after we define the buckets, we got your graph and what areas they fall within the risk scale. Let's think about building your house. So when we think about your investments, they're kind of going to go into a house. And let's think about a house. When you build a house, you build a house with a strong foundation, right? You really want to support the structure from up above. So on this foundation, we might want to think about putting your CDs, your savings accounts, maybe some very conservative bonds to support the structure up above. Then in the main part of your house, maybe this is where we put bonds that have maybe a little more risk to them. Maybe some stocks, large cap stocks, US, maybe developed international large cap stocks. Then when we get up to the top part of the house, we start thinking about what we're going to put in our roof, the smaller section, but maybe it has more risk to help grow those assets. So here we might put mid cap, small cap, or emerging markets in those areas.